Okay, so you want to invest in multifamily real estate and start to buy apartments, but you feel a bit confused with it, right? They're big buildings, right? They're big loans. There's phrases and terms you've maybe never heard of, like NOI and cap rate and pro forma and DSCR, all those things. Well, in this video, I'm going to teach you 4 simple, easy formulas that if you understand these formulas, you can invest in multifamily real estate, okay? So make sure you stick with me for this video. It's gonna be short, it's gonna be concise, it's gonna be very powerful and clear to the point, okay? If you don't know who I am, my name is Stephan. My wife and I right now we own 87 units. We're closing on a 56 unit apartment building. We do this ourselves. We do not raise capital. I do not have investors. I'm not a syndicator. I'm an entrepreneur. I built an online telehealth education company as a registered dietitian. We took the profits from there and we started buying multifamily apartments. And multifamily apartments, I feel, are the superior investment vehicle to help you and your family achieve financial freedom. But there's 4 formulas you have to know. And I don't care if you're a beginner, I don't care if you're advanced. If you don't know these 4 formulas, it's going to impede your success. So without any further ado, let's step into my office and let me teach you these 4 simple formulas so you can start to invest in multifamily real estate. All right, my friend, welcome to my office here. I'm gonna put the whiteboard on the screen here. I'm gonna teach you these 4 important formulas. I wish I would have understood these more when I started investing in apartments. Like I said, my wife and I now own 7 apartments. I've kind of learned these as I've gone, okay? And I think these are gonna be very important for you. Now, note, I'm not gonna do a full underwriting session here. I'm planning on doing that in a future video. If that would be helpful, how I underwrite my apartment deals, and it's not even just how I do it, but how a bank is going to do if you plan to use leverage, which you should be using leverage. You want to understand how the bank will underwrite an apartment deal. This definitely isn't enough. So don't plan to submit this to a bank as a business plan. They're gonna laugh at you or they're gonna be really scared about doing business with you. This is just like simple off the cuff formulas that you need to understand so you can build a multifamily portfolio and potentially an empire like my wife and I want to build. So without any further ado, let's get into it. Boom, whiteboard on the screen here. So the first one you have to understand is NOI divided by cap rate equals your valuation. So NOI is your net operating income. Again, it is literally as simple as income minus expenses equals the NOI. The only expense that does not come into consideration is going to be your debt payment. Okay, that's something a little bit different. So you never include your mortgage payment in an NOI calculation, okay? Now, where I see a lot of new investors get tripped up is a broker. So brokers are the lifeblood of this business. Love brokers, be cool with brokers, build relationships with brokers, okay? So I've bought 7 apartments. I bought 6 off market. The bigger one we're closing on next, or 56 unit, was also off market. Everyone always asks me, how do you get off market deals? Brokers, broker relationships. So a broker might tell you, hey, okay, the NOI of this deal here is $70,000 and we're offering it at a 6 cap. And you might wonder, oh, well, what's the price? They're going to expect you to know how to figure out the price. So let's just do this math simply. We know the formula now, right? I'm giving you these simple formulas. 70,000 divided by 0.06 equals 1.166 million. They would expect you to know that, okay? If you call a broker and you don't understand these simple things, that's where you can get into some trouble. And understand a cap rate is just my return on investment if I owned it in all cash, okay? So you would just divide the NOI divided by 0.06 because it's a percentage expressed as a decimal, okay? Very simple, right? NOI divided by cap rate equals your valuation. That's how I know too, if I can improve the NOI to, let's say, $100,000 and the cap rate remains the same, what's my property worth? Well, let's do that math. 100,000 divided by 0.06. Now my property's worth 1.66 million. This is how I'm able to do cash out refinances because I understand this simple formula. I would only buy a property where I can increase the NOI. How do you do that? You either increase the income or you decrease the expenses. If you cannot increase the NOI, do not buy. Okay, we'll say it again. If I cannot increase the NOI, do not buy unless you just want to park your money somewhere. Okay, so that's the first formula you have to understand. Number 2, Let's change up the color a little bit. 50% expense rule, okay? So remember, NOI is profit. It's income minus expenses, okay? So let's say you get sent a property. I don't really love that color. There we go. Let's say you get sent a property and they're like, hey, it generates $100,000 in income. Off the cuff, you should assume a 50% expense ratio. That means I'm going to assume $50,000 to run the property. Now, full transparency, my wife and I own our own management company. We self-manage our portfolio. And we actively manage our portfolio. Our expenses tend to be closer to 35, maybe 40%, okay? But if you're not going to actively manage, if you're going to use third-party management, or if you're not experienced, or if it's just a general rule of thumb, I'm going to always assume 50% expense ratio. Sometimes you'll see these crazy, especially when you're dealing with smaller properties and mom and pop owners, you'll see something like, oh yeah, we make $100,000 in income and we only have $15,000 in expenses. I'm not saying they're lying. I'm just saying there's no way that is humanly possible unless they're there fixing toilets, they're there painting the walls, or they're just not accurately reporting expenses, or they're bleeding the property, meaning that they are not taking care of it. There's no way, even 35% is extremely lean. We don't fix up units ourselves, but we manage contractors. We work really, really closely on our properties. We've been able to maximize that 35% expense ratio. But for a new investor, or for a rule of thumb, if I know the property is generating $100,000 in income, I'm going to underwrite at 50% expense ratio. Usually when I buy apartments, that's the expense ratio I see. If I see anything lower, it's one of those two scenarios. Either you're dealing with a mom and pop investor who's not accurately reporting, and then when you buy it, your expenses are going to be higher, or they're bleeding the property, which means when you buy it, there's going to be a lot of deferred maintenance. Okay, so that's what we just call the 50% expense rule. Again, simple math, right? Hey, is this helpful? Let me know. Leave a comment below, okay? The magic formula. This one's the key. This one, if you understand this, you can create wealth with apartment investing, okay? For every $1 I improve the NOI divided by the cap rate equals my valuation increase. Whoops. My valuation increase. So let's do some math here. Again, third grade math. Get your calculator out. Get your cell phone out. I own a property that's at a 6 cap, okay, 6% cap rate. Again, who sets the cap rate? I have other videos on this where I discuss this. Go check those out. Usually the appraiser, but the broker should be able to tell you about the area as well. So $1 divided by $1 divided by 0.06. Let's do that math. Forgot to put my phone on airplane mode, so my phone is going off. 0.06 equals $16.66 in valuation. This is what's important. I don't care about the dollar. I care about the NOI holla. Okay, that's my rhyme. That's my rap. Don't forget it. So I know, let's say, so again, I'll use my property as an example. I'm buying 56 units, okay, at a 6% cap rate. So I already know 0.06. I know because I know the area, because we own a management company, because we own other properties in the area, because we've done our due diligence. I know I can raise those rents $200 per unit. So let's do 200 multiplied by 56. That's $11,200. Okay, cool. Hey, if your property made an extra $11,200, oh, I'm sorry, that's per month. So if we want to look at the annual outlook, right? Because properties are always evaluated on an annual basis. Businesses are evaluated on an annual basis. They're going to say, show me a P&L for the last fiscal year or the last 2 or 3 fiscal years. They don't just look at 1 month, okay? So I know, let's just do the math together because I tend to talk fast, okay? 56 times 200. You're buying a 56 unit property. You know you can raise the NOI and the rents, okay? $11,200. So we know 11,200 times 12, do that math, $134,000 to the NOI. What did I say earlier? If you cannot buy, or if you cannot increase the NOI, do not buy, okay? So $134,400. Hey, great, you're business, because apartments are businesses, are now making $134,400 more money. So the property's worth $134,000 more, right? No. This, remember the magic formula, every dollar of NOI increase divided by the cap rate equals a valuation increase. So this is where stuff gets cool, okay? I was gonna swear, but here's where shit gets amazing, okay? So let's go 134,000. Let's just round it, 134,000 divided by 0.06. Woo, come on, man. 2.24 million. That's it. That's the game. That's the wealth. That's why I'm obsessed with apartments. That's why we used to buy single family. I will not buy single family anymore because you can't do this with single family. This is how businesses are valued. There's different terms for different businesses. In my online telehealth business, they called it EBITDA, earnings before interest, depreciation, taxes, amortization. But it's just profit. In apartments, it's called NOI, but it's just profit, right? This is what you have to understand. And this is exactly what I'm gonna do on my 56 unit. Follow along, make sure you subscribe to the channel. Are you getting excited? Are you seeing the power of this? Think if I had 100 units, think if I had 200 units. That's why numbers, scale, understanding this magic formula is a game changer, okay? If you have questions, I don't wanna spend too much time on it. If you have questions, I still have one more formula, one more thing to teach you. If you have questions, comment below. If this excites you, comment below. If you're, dude, I'm getting goose pimples, man. Because $200 times 56, guys, I know that may feel overwhelming. It's really not that hard if it's below market rent. Now, if it's not below market rent, that's different. That's where you have to know the property. But guys, come on, that's exciting stuff, right? $2.24 million in valuation increase. Your net worth goes up $2 million. You're a multi-millionaire on paper, right? On paper. Okay, our last formula here is what we call the 1% rent rule. Now, this formula, I would say is less important as the other three, but it is still useful. It's a useful tool in our tool belt as investors. So all this means, if I'm gonna pay, let's say $1 million for the property, okay, $1 million, I need to be able to make at least 1% of that purchase price in gross rental income. If I can do that, it's a good buy. If I cannot achieve that, it may be hard to cash flow the property. Again, maybe, not sure. Always do your due diligence. Let's just do the math. $1 million multiplied by 0.01, so that means 10,000. So if this puppy here, this property cannot make $10,000 a month in rental income or 1%, I should not buy it because it probably will not cash flow. And remember, when you're borrowing money from the bank, it needs to meet a 1.2 DSCR ratio. That means for every dollar of debt, you make $1.20 of income. If it does not have this one, I've never seen a deal pencil out. Maybe you will. Maybe you can find one. Great, good for you. And remember, you're probably not gonna buy it making $10,000. You might buy it and it's making $6,000. But you have to have the potential to raise it up to $10,000 or 1% of your purchase price, or else it probably won't cash flow, okay? So there we have it. Those are 4 formulas I use every day as an apartment investor, as a multifamily investor. Those are 4 formulas I wish someone would have explained to me when I started investing. Was this valuable? I don't make these videos for me, I make them for you. Was this valuable? Let me know, leave me a comment below. Did you like this style of content with the whiteboard on the screen? Let me know. If you have any questions about anything I spoke about here, drop a comment, okay? Hit the thumbs up if you enjoy it, subscribe so you can see this 56 unit I'm talking about. We're gonna walk you through the entire journey. I'm gonna bring you along with me. So make sure you subscribe so you see that. Leave me a comment below, and hey, if you enjoy this, check out the links below. I have a free book for you and I have a free masterclass. Literally, I did a 2-hour live training. People paid, they invested money to be in that room to learn from us, the speakers that were there. I'm giving you my entire talk all about building wealth with real estate for free. Click the link below. Until next time, my friend, thank you so much for being here. To your success. Talk soon. Thanks.